Howdy, Jacob here. Today we're looking at Ovintiv, company 94 of our high ROIC screener. We can see that this company is highly volatile on essentially all fronts, where their margins have been almost negative or have been negative in the last 10 years, but as high as 30% as well. Return on invested capital has been as high as 32% and as low as negative 42%. So pretty wild cyclicality here, where we're in the oil, gas, consumable fuels industry with 13.7 billion market cap and a 19.1 billion enterprise value. They develop and produce natural gas, oil, and natural gas liquids in the U.S. and Canada. They had quite a little bit of net debt here, which we do see on their balance sheet as well. 284 million short-term debt, 5.5 billion long-term debt, and just 3 million cash on hand. So they are rocking with a they're rocking highly illiquid. So what this would mean for you essentially is that, if you were an individual and you had a $5 million loan outstanding on your house and you just had $3,000 in cash on hand, that would be a concern. Yes, you have other assets. I totally understand that. You could sell off, maybe you own I don't know, Rolex would probably be, yeah, I mean, sure. You own a Rolex, you own your car, you own this, that, you can sell those off, but you don't want to. You shouldn't have to sell off things to be able to afford just paying back the debt that you have. And so just think about it from that perspective. They're highly illiquid with their assets and have a good amount of debt on hand. But let's see what that is in relation to earnings and free cash flow. So their free cash flow, 5-year average, huge capital expenditures here, but free cash flow is still probably producing, let's say, 1.5 billion. I guess we have 300 million and almost zero here, so it's probably averaging out to $1 billion on average. So that's still over 5 years, 5-year average free cash flow to pay back their long-term debt. And I mean, that's a little bit concerning. I mean, just one, if some bad things were to happen, they were to stop producing free cash flow. Yeah, to cover their interest, they're going to either have to issue more debt at a later date to pay for what's happening, the interest payments they'll have to do now, or they'll have to, sell some assets off. So that's not the most, it's not the healthiest thing to see. Um, their debt has been fairly consistent, but it seems like whenever they, pay it down, they just issue some more. So a little bit concerning there. Their 307 million total dividend payout is, like I said, probably like 30 to 40% of their 5-year average, and it's paying out 2%. But again, it's a cyclical company that has a good amount of debt and not a lot of liquidity. So I don't know. We're gonna have to let's make some assumptions here and just kind of walk through my thought process here. So revenue change, uh, I think it's gonna be relatively flat. I think they are at, I'm not saying the top of a cycle, but have definitely been through inflation and everything at the warmer end of the cycle. And so I'm gonna put 0% in, due to the fact that, I think over the next couple of years it could go down in revenue and then back up at the end of 7 years or something like that. I think we're going to see zero growth essentially over the next 7 years. It's going to be volatile zero, I think, but that's where I'm at. And then the PE, they'll probably still have. I mean, although it's cyclical, it's still slowly going up based on what I'm seeing here. So I'll still probably put a 12 on the PE and price to free cash flow. I don't. I usually do 15%, but due to them having no cash on hand and as much debt as they do, I'm going to put a 17.5% return. That's just me right now. Everyone's going to be different with their assumptions here. I'm just walking you through why I gave an extra premium on the discount rate, and it's due to them having no cash on hand with quite a bit of debt. And then on the margin side, I'll probably just do pretty close to an average here. Let's do 14 and 10 with so 140. Yeah, they have been buying back shares, but again, let's see. If they make $1 billion on average, it looks like currently they're paying 30% in dividends, 40% share repurchases, and then greater than that in acquisitions. So they're going into debt to fund some of these activities. Um, and I mean, that's just not where you want to be. If the company has to make acquisitions to grow, it's just tough because usually the acquisitions to grow on a revenue basis do not make your company more efficient, and it's not the best use of cash. The return on it, one, you might be overpaying for it likely, and then two, it's not even giving you um, greater margins or greater this, greater that. So I'll probably put no share changes, saying that maybe they do 10% or so of share repurchases, but it's going to get offset by, well, I guess they don't have share based compensation here. So let's do 0.5%. So that's going to have them, let's see, at 1.3, 130, 70. So about 10% of their money going towards share repurchases, 30% to the dividend. I think that's fine. Let's just keep that the same because it's unlikely people get rid of their dividends. But you want this company to be paying down some of that debt or at least gaining a little bit of cash on hand. I mean, again, that example sounded a little bit crazy, but on the same scale, that's essentially what it's like. 3 million cash on hand with 5.4 billion in long-term debt. So just the balance sheet isn't taken into perspective here, so you have to change some of your assumptions to kind of bring it in as much as you can based on interest rate hitting you or your interest rate payments hurting your margin or safety on the discount rate side or through your um, what use of cash, share change versus dividend versus your reinvestment rate and everything. And right now, based on everything I'm seeing, yeah, it just looks a little bit expensive and one that I would definitely have to do more research on before investing because I get a little scared when there's a lot of debt on a company, little cash, and yeah, that's my initial analysis on Ovintiv. So hopefully you enjoy the video and have a great rest of your day. Thank you.